A company just reported a staggering $500 million net loss for the first quarter of 2026. The algorithmic traders are, well, they are fleeing. But our findings reveal they actually generated over $30 million in positive free cash flow during that exact same quarter. This is zero herd mentality.
Yeah, we find value where others see fear. Today, we are doing a deep dive into our research on Northern Oil and Gas, or NOG. Our mission is to figure out if Wall Street's herd mentality is creating a massive mispricing here.
Right, because the market is aggressively penalizing this stock based on what is basically a pure accounting illusion. They are completely missing a structurally advantaged infrastructure-light business. I mean, this company consistently generates a 19% return on capital employed. So for every dollar they invest, they get 19 cents back in profit.
Exactly. Let's look at where that massive 522.8 million Q1 loss actually came from. Because when you really dig into the filings, it is mostly a mirage.
Yeah, it is driven by two rigid accounting rules. You have mandatory mark-to-market adjustments on their hedges, and then an antiquated standard called the full cost ceiling test.
Right, so basically when oil prices dipped in late 2025, the rules forced NOG to slash the recorded historical value of their assets based on backward-looking prices. So it is a massive paper write-down. I mean, no actual cash left to build it.
It is like owning a fully rented, cash-flowing apartment building and suddenly getting its paper appraisal slashed just because a house down the street sold for less.
That is a great analogy.
The actual rent checks hitting your bank account have not changed at all. Stripped of that non-cash noise, our research shows they generated $342.5 million in adjusted EBITDA in that exact same quarter.
Which their core operating profit. So, how are they generating that kind of cash while looking so bad on paper? Well, that comes down to their unique model.
Yeah.
NOG does not actually own or operate the drilling rigs. They buy minority working interests alongside Tier 1 operators.
Which gives them a profound cost advantage, right?
Oh, absolutely. Traditional oil companies spend a fortune on bloated corporate headquarters, engineering teams, rig maintenance, you name it.
But by just riding shotgun on these leases, NOG circumvents all of that. They dropped their general and administrative overhead to roughly $1.01 per barrel. That is just a tiny fraction of what the operators are paying.
And because they are not tied down to keeping specific rigs running, they have immense capital flexibility. They are currently out there executing counter-cyclical acquisitions, like they are buying premium Canadian Duvernay assets at multiples of less than 3 times cash flow.
Wow, meaning those assets essentially pay for themselves in under 3 years.
Exactly. And they are doing this while the rest of the industry is sweating the cycle.
And the insiders clearly see this disconnect too. In early 2025, directors Bharam, Akroti, and Stuart Lasher deployed over $1.6 million of their personal capital to buy the dip.
Yeah, when the people with the most intimate knowledge of the actual oil reserves are aggressively buying during a perceived crisis, well, it is a strong signal they view the market's pricing as irrational.
Wait, though. I have to push back here. If they do not operate the rigs, does not that mean they are entirely at the mercy of the operators? I mean, if the big partners decide to pack up and stop drilling to harvest cash, NOG's production just falls off a cliff.
That is a fair point, and it's the primary structural risk. We call it operator capital starvation in our research.
Yeah.
If their partners systematically stop funding those joint leases, NOG's production declines, regardless of how good their land is. It is the inherent vulnerability of the non-operated model.
Right. We also have to monitor what our research flags as leveraged indigestion.
Yeah, if they borrow too much debt to fund all these rapid-fire acquisitions.
Exactly. If their net debt structurally exceeds 2 times their core operating profit, this entire thesis of capital discipline shatters. If they abandon their target leverage to blindly chase growth right before a sustained commodity crash, this stock becomes a trap.
But when you stack the minimal overhead, the insider conviction, and the actual cash generation against those risks, it is hard not to see this as a massive valuation disconnect. Our verdict is a high conviction buy.
The math is glaring. The public market is pricing the entire company at merely $2.37 billion. Yet, if we look at the PV10, which is the verified, discounted cash value of the physical oil they already have sitting proven in the ground, it is worth $4.5 billion.
We are essentially paying a deeply discounted price for a highly profitable business.
It all comes back to that apartment building getting a bad appraisal. Which leads to this final thought for you to consider. NOG is actively planning to transition their internal accounting methodology from that antiquated full cost method to successful efforts.
Oh, right. And this switch will instantly erase those artificial ceiling tests and the resulting earnings volatility.
Which leaves us with a fascinating scenario. What happens to Wall Street's algorithms when those financial screens suddenly update to reflect the underlying cash flow reality?
The illusion vanishes.
Will you be positioned before the machines figure it out?